Historians of the stock market argue that now is the time to invest. Nevertheless, why is that the case? Despite the fact that the S&P 500 market in the United States has fallen by over 20% since the beginning of the year, investing in equities is always risky. Losses are common even for seasoned investors. Yet, the trick is that the best traders also know how to minimize their losses. So, if you want to find out how and why do you think this present time is the best opportunity to invest, then keep watching. Because this is Investing Path, where we will give you the exclusives and the latest updates related to personal financing and the stock market. Make sure to hit the like, subscribe, and bell button to stay ahead with our content. But other than that, let's get started. To begin, why does now represent the best time to put money into the market? After 50 years of research, it is obvious that the recession and inflation are the two constant economic forces that influence the stock market. And while it is true that nobody can confidently predict what the stock market will do next, we do know that there are sweet spots or ideal entry moments to invest in the stock market. These optimal times can be anticipated with relative ease as they frequently coincide with economic downturns and other cyclical events. Hence, if you're looking to buy shares of a major corporation, the best time to do it is during a market downturn, when they'll be priced lower. If you ask Warren Buffett, he does not seek to foresee the market, but he'll tell you that he works hard to locate bargain investments. The stock market reacts negatively to a recession because of the effects on the global economy. The extreme volatility of cryptocurrencies makes them particularly vulnerable during economic downturns. Consider Bitcoin as an example. After peaking at over $68,000 a year ago, its price has now dropped to under $17,000, in part owing to inflation. What impact does this have on the stock market though? When costs rise due to inflation, businesses have less money to spend on essential commodities. Because of this, businesses must either raise prices or reduce output. After that, buyers start looking for cheaper options. Those businesses that fail to cultivate a loyal following will see their stock value decline. But this doesn't mean inflation never has a positive effect on the stock market. Although experts have agreed that low and controlled inflation is best for economy, research reveals that some stocks do rather well amid inflation. In conclusion, while inflation has some positive effects on the economy, it also raises concerns about the stability of the stock market. Locating your entry points into the stock market is as simple as finding a website that you enjoy using to get in-depth information and updates on the stock market's developments. Popular resources in this area include TipRanks, Seeking Alpha, the Motley Fool Stock Advisor, etc. The crucial thing is that some of these platforms contain articles on the stock market written by specialists, while others allow you to keep track of your trades and use proprietary algorithms to read the market. But in order to access the most useful and advanced features, you will need to pay a subscription price on most of these platforms. You don't want to invest just to invest. You want to take advantage of the possibilities that recessions bring to make a profit on the stock market. Knowing when to invest is the half fight in learning how to invest and make profits. When it comes to making investments, the approach you take should be tailored to your knowledge and objectives. When we say expertise, we are referring to how well you know the stock market. So first, let us talk about the dollar cost averaging. Dollar cost averaging is the simplest and most widely available approach to investing in the stock market. But how exactly does it function? All investors are aware of the stock market's inherent volatility and the general rule that the greater the risk taken, the greater the potential reward. Contrary to this belief, the dollar cost averaging technique is not about generating a quick buck, but rather about building wealth steadily over time. Due to its conservative nature, the dollar cost averaging method allows you to spread a predetermined amount of money among various stock market investments without taking on any additional risk. You will need an index trust, the largest and most well-known of which is SPDR S&P 500 ETF Trust. Despite the intimidating nature of its name, the mechanism itself is really straightforward. Let us pretend you want to start investing $500 monthly. Whichever index fund you go with will divide that sum up and acquire all of the equities on the market that month. Assume the FTSE 500 only purchases 10.5 shares in the first month. After 3 months, you will have invested $1,500 in the stock market and acquired approximately the same number of shares. But the stock market gets even more pessimistic after 4 months. The same $500 will now purchase 20.5% more shares. What makes the investment plan so effective is that it allows you to capitalize on market opportunities without requiring any adjustments to your investment process. Similarly, because you are reducing your exposure to risk, dollar cost averaging makes it simple to generate a steady return on your investments. Contrary to what was stated previously, the dollar cost averaging technique does not necessitate that you closely monitor the market. But this does not render the strategy infallible. Indeed, it is possible to incur some minuscule losses while employing this tactic. Next, the Warren Buffett method is another viable option. This approach is favored by experts for good reason. It not only provides the chance to generate a larger profit, but also follows 9 key concepts that have helped Warren Buffett develop this wealth to this point. Our third strategy is tax loss harvesting. The idea behind this tactic is to offset the gains made by selling off some of your stock holdings at a loss in order to make up for the profits you made on the sale of other stocks. After subtracting your deductions and credits, your taxable income will be lower. If you want to maximize your profits, you should invest your windfall using the tax loss harvesting approach. It is really technical, so consult a tax expert before trying to use it. Understanding the mechanics of panic selling is crucial, as it accounts for a significant portion of stock market losses. The term panic selling refers to a sudden and widespread sale of stocks by nervous investors. They take this action in anticipation of a further decline in stock prices in the hopes of recouping some of their losses. There are few causes of panic selling, but the most common ones include overreaction and a loss of faith in the company's capacity to recover from bad debt. Now, for the exciting part, a good time to enter the stock market is during a period of widespread panic selling. It is human nature for people to worry and sell in such situations. When individuals panic and sell, the price decrease is typically highly aggressive, giving it an ideal area for stop-loss orders, which even skilled investors use in case the market does not favor their prediction. Now, there are also several strategies that you should keep in mind for capitalizing on the market, while also minimizing the losses. All you need to do first is really learn as much as you can about the company you are considering investing in. Doing so is sensible given the current economic climate, wherein only businesses with strong price-passing powers and low debt levels are guaranteed to survive even the worst economic recessions brought on by inflation and high central bank interest rates. For those who aren't familiar, price-passing power refers to a company's ability to increase the prices of their products without seeing a major decline in sales. The price of a Coca-Cola beverage, for example, has increased over the years without causing a significant decline in the company's sales. Why? Because it enjoys a substantial advantage over its rivals in the beverage market. When the financial market is impacted by major causes like inflation, a recession, or a high interest rate, a company's price-passing power determines how well it can weather the storm. Ask yourself, will this company stay solvent when there are scary economic recessions before committing your money to any company? Lastly, if you feel the want to sell your stocks in a panic, remember that this behavior has a poor track record. Holding a firm when business conditions are unfavorable might pay off in the long run. For instance, the S&P 500 fell by 30% during the pandemic, and investors who sold their shares out of fear lost 65% of their annual gains compared to those who kept calm. Even though we just emphasized that it is never a good idea to panic, there are situations when selling off losing investments is the smartest thing to do. An example is back in February 2022. Facebook stocks dropped by 26.4% after dropping by only 15.5% the month before. if you had invested $1 million in Facebook stock in September 2021, you would have lost $720,000 by February 2022. We can't speak for everyone, but even a seasoned investor would probably rethink this. If you do your homework, you won't have to make decisions like this very often. But so far, what do you think of these strategies? Do you think they're helpful enough to motivate you to start investing? Or do you still have other tips in mind that you believe are more effective than ours? Share your thoughts in the comment section below. But besides that, thanks for watching. This is Investing Path. And if you enjoyed watching this video, please go ahead and hit the like and subscribe button and hit the bell button as well to stay updated for more of our future uploads. Thanks again for watching, and we'll see you in our next video.